Okay, so you want to own a waste management company. Fleets of trucks rolling out at dawn, a logo on every bin in the county, a business that never goes out of style because humans will never stop making garbage. Recession-proof, recurring revenue, boring in the best way, the kind of business a rich uncle tells you to buy instead of a tech startup. Here's the problem. Almost none of that is how this business actually works. That boring recession-proof cash machine story is the illusion, the one private equity uses to sell you on rolling up route after route, and the one nobody bothers to correct because the people who know better are usually the ones buying, not selling. Let's start with scale, because the numbers are genuinely massive. The U.S. waste and recycling industry generates somewhere around $75 to $100 billion a year. Americans throw out roughly 290 million tons of municipal solid waste annually. There are tens of thousands of hauling companies nationwide. Sounds like an ocean of money, right? Now here's the undercut. Net margins for a standalone hauling operation typically run 3 to 8%, not 20, not 15, somewhere between 3 and 8. You're wading through a $90 billion river and getting to keep a teaspoon of it. And waste management company isn't one business. It's at least 3 wearing the same overalls. There's residential curbside, low margin, contract dependent, brutal on trucks and labor, subsidized only by volume and long municipal contracts. There's commercial and industrial hauling, fewer stops, denser routes, meaningfully fatter margins because you're billing businesses who don't shop around every month. And then there's the one nobody thinks about when they picture a garbage truck, landfill and transfer station ownership, which isn't really a service business at all. It's a real estate, and permitting monopoly wearing a service business's clothes. Now the part where the viewer's stomach is supposed to drop. What does it actually cost to get in the door? A single new rear loader or side loader truck runs $250,000 to $350,000. A recycling capable truck can push past $400,000. If you're starting a hauling operation from scratch with even a modest fleet of 8 trucks, you're looking at $2 to $3 million in vehicles alone before a single wheel touches pavement. Add a facility, a yard with fueling, wash down, and maintenance bays, and you're another $500,000 to $2 million depending on whether you're leasing or building. Commercial insurance for a fleet this size, given how dangerous this job actually is, runs $150,000 to $400,000 a year before you've hauled a single bag. Licensing, permitting, and municipal bonding vary by state and city, but commonly add another $50,000 to $250,000 just to be legally allowed to operate. Add containers and dumpsters you'll need to supply commercial clients. Figure $300 to $200 per unit, multiplied by however many accounts you're chasing. Total cost to simply open the doors on a small regional hauler, somewhere between $3.5 and $6 million, and that's before payroll hits your account for the first time. So where does the money actually come from? Here's what nobody tells you going in. The truck rolling down your street, the part of the business you can actually see, is the weakest link in the entire chain. Curbside residential collection is usually billed through municipal contracts at fixed rates, negotiated years in advance, and it's the layer most exposed to fuel costs, labor shortages, and public pressure to keep rates low. It's often close to break-even on its own. It exists to build density and win the next layer. The next layer is commercial and industrial collection, dumpsters behind restaurants, retail centers, office parks. This is where real margin starts to show up, because pricing isn't set by a city council. It's set by you, and businesses rarely switch haulers even when a competitor is cheaper, because nobody wants to deal with swapping out dumpsters and retraining staff on where to put things. That inertia is worth real money. Commercial accounts routinely run 15 to 25% operating margins, where residential runs closer to 5%. Then there's the layer that actually explains why the big players keep buying landfills instead of just buying more trucks: tipping fees. Every truck, yours or a competitor's, has to dump somewhere. And if you own the landfill, every single truck that pulls onto your scale, including your competitors' trucks, pays you. Tipping fees average $55 to $70 a ton nationally, and in states with limited landfill capacity, they can run past $100. A single mid-sized landfill accepting 2,000 tons a day at $60 a ton is generating $120,000 a day in gate revenue. That's not a garbage business anymore. That's a toll booth with a permit. And the deepest layer, the one that made this industry genuinely irresistible to Wall Street, recyclables and recovered materials as commodities. Cardboard, aluminum, and certain plastics get sorted, baled, and sold on commodity markets, which means a portion of your revenue is quietly tied to the price of scrap metal and pulp on any given week. When commodity prices spike, recycling facilities can post margins that make the rest of the business look like a rounding error. When they crash, like they did in 2018, when China stopped accepting most foreign recyclables, that same revenue line can go negative overnight, because you're now paying to process material nobody wants to buy. Here's the insider trick almost nobody outside the industry has heard of: landfill airspace accounting. A landfill isn't valued like a building. It's valued like an oil well, based on remaining permitted capacity, measured in cubic yards of airspace left before the site is full. Companies book depletion of that airspace the same way an oil company books depletion of a reserve, which means the value of the asset on paper shrinks every single day it's operating. But simultaneously, every acre of nearby land that could plausibly be permitted for expansion becomes worth a fortune, because new landfill permits are almost impossible to get approved anywhere near population centers. So the real game insiders play isn't running the landfill efficiently. It's controlling the only parcels of land within 100 miles that could ever legally become the next one. You're not selling waste disposal. You're cornering a permitting monopoly and calling it operations. Now the daily bleed, the part that erodes the fantasy 1 gallon of diesel at a time. Diesel fuel alone can run $8,000 to $15,000 per truck per year, depending on route density and fuel prices. A qualified CDL driver, given the physical demands and turnover in this industry, costs $55,000 to $75,000 a year fully loaded with benefits. And driver shortages mean you're often paying above market just to keep trucks moving. Maintenance on a garbage truck is brutal. Hydraulic compactors, constant stop and go, heavy loads figure $18,000 to $25,000 a year per truck in upkeep. Financing on that fleet, if you didn't pay cash, adds thousands more per truck per month in interest carry. Add software for route optimization, weighing systems, and regulatory compliance reporting, and you're bleeding money every single day whether or not a single truck leaves the yard. Run the math on an 8-truck fleet, and you're looking at $600,000 to $900,000 a year just to keep the lights on and the wheels turning before a single dollar of profit shows up. Here's the structural risk, the one domino that can take the whole thing down: landfill access. If you're a hauler without your own disposal site, every ton you collect has to go somewhere, and that somewhere is controlled by someone else, usually a handful of large regional players who also happen to compete with you for commercial accounts. When your only nearby landfill is owned by your biggest competitor, they can raise your tipping fee whenever they want, and there's often nowhere else within an economical driving distance to dump instead. This isn't bad luck. It's baked into the geography. Landfills are capital-intensive, environmentally regulated, and nearly impossible to newly permit, so the number of disposal sites in any region is essentially fixed. Whoever owns the scarce asset owns the leverage over everyone who doesn't. For a real case study, look at Waste Management, Inc., now branded WM, which figured this exact structure out decades before most of its competitors did. Founded in Chicago in 1968, The company spent the 70s and 80s aggressively rolling up small independent haulers across the country. But the real strategic shift came when leadership realized owning landfills, not trucks, was where durable pricing power actually lived. By vertically integrating collection, transfer, and disposal under one roof, WM insulated itself from the exact tipping fee squeeze that kills smaller haulers. Today, WM operates roughly 260-plus active landfill sites and generates north of $20 billion in annual revenue, with disposal and recycling segments carrying meaningfully higher margins than the collection trucks that get all the attention. The stock has been one of the quietest, steadiest compounders in the entire industrial sector for the better part of 3 decades. Not because garbage trucks are exciting, but because the company that owns the hole in the ground gets paid no matter who's driving. This is exactly how the smart players do it differently. They don't compete on collection efficiency, because collection is a low-margin commodity service. They buy landfills and transfer stations first, then build or acquire the trucking fleets that feed them, so every competitor's truck effectively pays rent into their business too. Large operators also use tuck-in acquisitions, buying small family-owned haulers in a region, often at modest multiples, then routing all that volume through their own disposal infrastructure, instantly boosting margins on assets that individually looked unremarkable. And some of the largest players increasingly treat landfill gas capture and renewable natural gas conversion not as an environmental side note, but as its own profit center, selling captured methane into energy markets, turning a regulatory liability into a second revenue stream. Now the math that shows you the swing between a good year and a bad one. In a good year, a mid-sized regional hauler with 8 trucks and roughly 4,000 residential and 200 commercial accounts might pull in $9 million in revenue, with fuel prices stable, low driver turnover, and steady tipping fees, landing around $650,000 in net profit, a healthy 7% margin. In a bad year, the same company faces a diesel price spike, loses 2 experienced drivers it can't quickly replace, absorbs a 15% tipping fee increase from the regional landfill it doesn't own, and watches a competitor undercut 3 of its biggest commercial accounts. Same $9 million in revenue. Net profit, maybe $90,000 if it's lucky, a margin so thin a single bad insurance claim or a truck engine replacement wipes it out entirely. Same business, same trucks, same routes. The difference between a great year and a forgettable one comes down to variables you don't control: fuel, landfill pricing, and driver retention. So is it worth it? Here's the honest verdict. If you're going in planning to just run trucks and collect residential bins, this is a hard, thin margin, physically brutal business that will quietly wear you down for years before it makes you real money. If it ever does, you're renting your margin from whoever owns the landfill you depend on. But if you can get into this with disposal capacity, transfer stations, or land positioned near a future permitting opportunity, the economics flip entirely, because you stop competing on service and start collecting rent from everyone who has to use you. This business is genuinely good for patient operators willing to spend a decade rolling up small accounts and eventually securing disposal infrastructure. And it will quietly ruin anyone who goes in thinking a fleet of trucks alone is a moat. Waste management was never really about the garbage. It was about who controls the last hole in the ground anyone's allowed to dig.